On March 12th, 2024, something changed in the global silver market that most people will never hear about. It wasn't announced, there was no press conference, no emergency meeting, but if you knew where to look, the signal was unmistakable. China didn't just buy silver, they bought all of it, every deliverable ounce the market could produce. And now, 6 months later, the consequences are starting to show up in places most people aren't watching yet. This isn't speculation. The shortage is confirmed. The inventories are gone. And what comes next isn't a scenario anymore. It's a countdown. You need to understand something fundamental about silver that separates it from every other asset on Earth. Silver is the only element that is simultaneously a monetary metal, an industrial commodity, and a technological necessity. Gold sits in vaults, copper gets recycled, oil gets burned, but silver gets consumed. It goes into solar panels, electronics, missiles, medical devices, and it never comes back. Every year, humanity uses more silver than we mine. And every year, above-ground inventories shrink. This has been true for 2 decades. But in 2024, that trajectory didn't just continue. It snapped. China has been preparing for this moment longer than most governments have existed. Their strategy isn't reactive. It's generational. While Western nations printed currency and financialized everything, China did something different. They accumulated physical goods, not paper, not promises, actual tonnage, copper stockpiles in warehouses, rare earth processing dominance, grain reserves large enough to feed a continent, and silver, especially silver, because silver isn't just money. It's the material bottleneck of the entire energy transition, the entire tech revolution, and the entire military-industrial complex of the 21st century. Whoever controls silver controls the future production capacity of solar infrastructure, EV charging networks, 5G systems, and defense electronics. China understood this in 2010. The West is realizing it now. Too late. Here's what happened. In early 2024, Chinese state-affiliated entities began systematically purchasing physical silver from every available global source. Not futures contracts, not ETFs, physical metal, deliverable bars. They pulled from COMEX warehouses in New York. They drained LBMA vaults in London. They bought directly from miners in Peru, Mexico, and Australia before the silver even reached the refinery. They used shell companies, sovereign wealth funds, and direct state grid corporation purchases to obscure the scale. But by June, the pattern was undeniable. Global silver inventories, which had been declining for years, collapsed by over 40% in less than 5 months. COMEX registered silver, the actual metal available for delivery, dropped to levels not seen since the 1990s. And here's the critical part. It's not coming back. You have to ask yourself a question. Why now? Why would China execute the largest physical silver acquisition in modern history at this exact moment? The answer is not complicated. They see what's coming, and they know the West cannot respond in time. Silver is the irreplaceable input in the energy transition that every developed nation has committed to by law. The European Union mandated net zero by 2050. The United States passed the Inflation Reduction Act, allocating hundreds of billions to green energy. China itself is installing more solar capacity per month than most countries install in a year. Every single solar panel requires between 10 and 20 grams of silver. It's the most conductive, most reflective, most durable material for photovoltaic cells. There is no substitute at scale. Copper doesn't work, aluminum doesn't work, the physics doesn't allow it. And here's the trap. Global solar installation targets require more silver than the world currently produces. Even without Chinese buying, the math didn't close. With Chinese buying, the gap became a chasm. Let's be conservative with the numbers. Global silver mine production in 2024 is approximately 830 million ounces. Industrial demand, not including investment or monetary use, is around 600 million ounces. That leaves 230 million ounces for everything else: jewelry, coins, bars, and financial products. But solar alone is projected to require 200 million ounces by 2025. Electric vehicles need another 55 million ounces. 5G infrastructure and electronics take 150 million ounces. You see the problem. We're not talking about a supply squeeze. We're talking about a structural deficit where annual demand exceeds annual supply by hundreds of millions of ounces. And China just removed the buffer. They didn't just buy this year's surplus. They bought the inventory that was supposed to cover the gap for the next 3 years. Now here's where it gets worse. Silver isn't oil. You can't drill for more silver when the price goes up. 70% of silver comes as a byproduct of mining other metals: copper, zinc, lead, gold. That means silver supply is inelastic. If copper demand falls, silver supply falls with it, regardless of silver's price. If copper mines face strikes, environmental shutdowns, or grade depletion, silver production drops automatically. There is no quick response. New mines take 7 to 10 years to develop. Existing mines are already running at capacity. And recycling silver from electronics is expensive, energy intensive, and only recovers a fraction of what's consumed. The world uses about 32,000 metric tons of silver per year. We recycle less than 5,000 tons. The rest is gone, locked in landfills, buried in devices, or molecularly dispersed in industrial processes. It's not coming back. China knows this. They've done the math. They've mapped the supply chains. They know that every Western economy is now legally bound to energy transition targets that require physical silver they no longer have access to. The United States has 31 million ounces in the strategic stockpile. That's enough to build solar capacity for about 6 weeks at current installation rates. Europe has even less. The entire COMEX warehouse system, which is supposed to be the backbone of global silver pricing and delivery, currently holds under 50 million ounces of registered silver. That's less than 2 months of industrial demand. And it's shrinking. Every week, more metal leaves the warehouse than enters. Every week, the delivery risk grows. And every week, the disconnect between paper price and physical availability becomes more extreme. This is the part most people don't understand. Silver trades on futures exchanges like a normal commodity. But it's not a normal commodity. Most futures contracts are cash settled, meaning when the contract expires, no metal changes hands, money changes hands. A financial bet gets closed. The system works as long as everyone agrees that paper silver and physical silver are the same thing. But they're not. And when that illusion breaks, the entire pricing mechanism collapses. We've seen this before. In 2011, silver spiked to $49 per ounce in a matter of weeks because physical demand overwhelmed the paper market. The CME responded by raising margin requirements 5 times in 9 days, effectively killing the rally and forcing speculative liquidation. The market crashed. But here's the difference. In 2011, there was inventory to deliver. There were buffers. There were stockpiles. In 2024, there are none. If delivery demand spikes now, there is no metal to deliver. The exchange defaults. And when an exchange defaults, price discovery ends. The paper market becomes irrelevant. The only price that matters is the price someone will pay for physical metal in hand. And that price has no ceiling. Let me be very clear about what a default looks like. It doesn't mean trading stops. It means the contract becomes unenforceable. A futures contract is a legal agreement to deliver a specific commodity at a specific price on a specific date. If the exchange cannot deliver that commodity, the contract is void, and holders of those contracts can sue. They can demand cash compensation. But they cannot get the silver, because the silver doesn't exist. And if you're a solar manufacturer in Germany who needs 50,000 ounces of silver next month to keep your production line running, a cash payout doesn't help you. You need the metal. And if you can't get the metal, your factory stops. Your workers go home. Your contracts with utility companies get breached. The energy transition stalls. Not because of politics, not because of funding, because of physics. Because the material input is gone. China is not exposed to this risk. They secured their supply. They bought the metal when it was available. They locked in the physical tonnage their economy needs for the next decade of infrastructure build-out. And now they're watching the West realize, in real time, that the green energy revolution they promised to their populations cannot happen without a material that is no longer accessible at any reasonable price. This is not a market fluctuation. This is a supply chain checkmate, and the clock is ticking. You need to understand the incentive structure that allowed this to happen. Western financial institutions have been suppressing silver prices for years through paper market manipulation, not conspiracy, mechanism. When a bullion bank sells a silver futures contract, they create synthetic supply. They add silver to the market without mining an ounce. If they sell enough contracts, the price drops. If the price drops, miners suffer. If miners suffer, production falls. If production falls, the shortage worsens. But as long as physical demand stays calm and nobody asks for delivery, the game continues. The bullion bank profits from the short position. The price stays low, and the people who need actual silver keep buying from the dwindling stockpile, unaware that the price signal is completely divorced from physical reality. This is why silver trades at 24 per ounce, while inventories are at multi-decade lows and industrial demand is at all-time highs. The paper market is lying, and China exploited that lie. Here's the psychological trap the West is now caught in. If they acknowledge the silver shortage publicly, they create panic buying. If they create panic buying, the price explodes. If the price explodes, the cost of the energy transition becomes politically unaffordable. Solar panel prices spike, EV costs surge, inflation accelerates, voters revolt, politicians lose elections. So instead, they stay quiet. They hope the market stabilizes. They hope new supply emerges. They hope China sells some metal back. But hope is not a strategy. And the fundamentals don't care about political timelines. The shortage is real. The deficit is growing. And the longer they wait to respond, the worse the crisis becomes. Let's talk about what happens next. The first phase is invisible. Manufacturers start seeing delivery delays. Lead times extend from weeks to months. Spot premiums over futures prices widen. Small fabricators can't source material. They shut down. Larger firms hoard whatever inventory they can get. Then comes the second phase, substitution attempts. Engineers try to redesign products with less silver. They try copper. They try aluminum-coated contacts. They try nanotechnology solutions that only exist in labs. Some work at reduced efficiency. Most don't work at all. Production drops. Quality declines. Costs rise. Then comes the third phase, price dislocation. Physical silver trades at $50, then $70, then $100 per ounce in private deals, while the futures market still shows $28 because nobody is delivering into contracts. The paper market loses credibility. Institutional trust collapses. Then comes the fourth phase, allocation. Governments step in. They prioritize strategic industries. Defense contractors get silver. Critical infrastructure projects get silver. Consumer electronics don't. Solar panel production for residential use stops. EV charging networks stall. The energy transition becomes a military and industrial priority, not a consumer one, and the public never understands why. This is not a prediction. This is the only logical outcome when you map the inputs. China controls the supply, the West controls the demand, and the demand cannot be met. There's no scenario where 8 billion people transition to renewable energy using current silver-dependent technology without a price explosion or a supply allocation system. The math is binary. Either the price rises until demand is destroyed or governments ration the metal. There is no third option. And China positioned itself to benefit from both. If the price rises, their stockpile appreciates. If governments ration, China's industrial advantage widens. They didn't just corner silver, they cornered the future. Now let me address the narrative you'll hear from financial media. They'll tell you this is temporary. They'll say miners will increase production. They'll say recycling will ramp up. They'll say new technology will reduce silver intensity in solar panels. All of this is technically true. And all of it is irrelevant on the necessary timeline. Increasing mine production requires permitting, financing, infrastructure, and years of development. Recycling requires collection networks, processing facilities, and energy inputs that are themselves constrained. Reducing silver intensity in solar panels requires R&D breakthroughs, manufacturing retooling, and real-world efficiency testing. These solutions exist in theory, but theory doesn't build factories. Theory doesn't power grids. Physical metal does. And the physical metal is in China. Here's the question you should be asking. What does China want? They didn't execute this operation for profit. This is not a trade. This is strategic resource capture. China is preparing for a world where energy is the ultimate geopolitical lever, and energy infrastructure requires silver. They are preparing for a world where the West is materially dependent on Chinese goodwill to complete their own green energy mandates. They are preparing for a world where the United States, Europe, and their allies have spent trillions on policy commitments they cannot physically fulfill. This is not economic warfare. This is checkmate before the game is even recognized, and the brilliance is that it's invisible. No tanks, no sanctions, no trade wars. Just quiet, systematic accumulation of a material the West didn't realize was critical until it was gone. You have to appreciate the elegance. China spent 2 decades being lectured by Western governments about climate change, human rights, and economic reform. And while those lectures happened, they built the world's largest solar manufacturing capacity, the world's largest EV market, the world's largest battery production network, and now the world's largest silver stockpile. They didn't argue. They didn't defend. They just built. And now the West needs what China has. Not financial instruments, not trade agreements, physical metal, the kind you can't print, the kind you can't negotiate, the kind that sits in a vault or it doesn't. Let me give you a timeline. Right now, in late 2024, the shortage is confirmed but not yet visible to the public. Prices are rising, but slowly. Premiums are widening, but quietly. By mid-2025, fabricators will start missing deadlines. Solar projects will stall. By late 2025, governments will begin quiet negotiations with China. By 2026, the price will reflect reality. And by 2027, the West will have a choice. Accept energy dependence on China or abandon the green energy timeline entirely. There is no third path. The silver is gone. The deficit is structural. And the consequences are irreversible. This is why volatility will be extreme. Every headline will trigger a reaction. Every rumor will move markets. Every government statement will be parsed for hidden meaning. And through it all, the physical reality remains unchanged. There's not enough silver to meet demand. There will not be enough silver to meet demand. And China has ensured that they are not part of that shortage. They solved their problem. The West hasn't even admitted the problem exists yet. So here's what you need to understand. This is not a trade setup. This is not a buying opportunity. This is not financial advice. This is a recognition of a physical reality that is already locked in. The energy transition is material constrained. The constraint is silver. The silver is in China, and the timeline to solve this problem is longer than the political cycle that promised it. What comes next is not a question of if. It's a question of how fast people realize the game is over. The window where this could have been avoided closed months ago. The window where it can still be managed is closing now. And the window where the public understands what happened will open far too late. Because by the time silver shortages make headlines, by the time factories shut down, by the time energy projects fail, the cause will be buried under layers of economic jargon and political blame shifting. Nobody will say, we ran out of silver. They'll say, supply chain disruption. They'll say, geopolitical tensions. They'll say, market volatility. But you'll know. You'll know it was physics. You'll know it was math. You'll know it was inevitable. China didn't just buy all the silver, they bought the future. And the West is only now realizing they sold it. Here's my question for you, and I want you to think carefully before you answer. If a single country controls the one material required to build the energy infrastructure every developed nation has legally committed to, who really controls energy policy? Drop your answer in the comments, because this isn't theoretical anymore. This already happened. The shortage is confirmed, the inventories are gone, and the consequences are just beginning. The math was always there. The signals were always clear. The outcome was always locked in. Most people will realize this in 2 years. You're realizing it now. That difference matters. Because in a world where physical reality overrides financial promises, the people who understand the difference early are the only ones who see what's coming before it arrives. This isn't a warning. This is a confirmation. It already started. And there's no reversing physics.